Funding for Market Journal is provided by the Nebraska Corn Board.
Growing more with less is the mantra of Nebraska's corn farmers, and they're using incredible technology to do it. Soil moisture monitors let them know when their crop needs water and how much. GPS systems eliminate overlaps in the field, saving fuel and money. New hybrids reduce the use of pesticides and increase yields. When you're talking new technology and innovation, Nebraska corn farmers are all ears. Nebraska's family corn farmers, sustaining innovation.
Market Journal, television for agricultural business decisions, is a presentation of the University of Nebraska-Lincoln's Institute of Agriculture and Natural Resources. Promotional support is provided by the Nebraska Farmer Magazine, and major funding for Market Journal is provided by the Nebraska Corn Board.
Welcome to this week's edition of Market Journal. I'm Jeff Wilkerson. On this episode, Jeff Peterson looks at the rally in soybean prices. Greg McKee explains how the Section 199A deduction affects farmers. David Widmar discusses U.S. meat consumption, and Roger Elmore gives guidelines for evaluating corn plants during the growing season. Jeff Peterson from Heartland Farm Partners is our market analyst this week. The U.S. Department of Agriculture says moisture conditions have continued to deteriorate in Argentina's largest soybean growing region, where rainfall from November through January was 1/5 of normal. Traders seem to have noticed. In the first 3 sessions of the week, the March contract gained more than 30 cents. While Argentina accounts for a comparatively small percentage of world soybean exports, it can make up nearly half the global oil and meal trade. The situation is more favorable to the east, where Brazil's harvest has just begun, and the USDA believes yields could push the country close to what growers saw during last year's record crop. We talked with Jeff Wednesday afternoon and began by asking him to dissect the soybean market rally.
You know, this rally goes all the way back to really the middle of January, and it's really hard to believe, Jeff, but we're up about 5.9%. We started off at 960, and today we're in the mid, 1015, 1017 area. And the big run, has really been over on the meal side. It's really all about the meal, and that same amount of time, meal's been up 16.7%. So there's concerns coming out of South America. But the big thing we have to remember is that even though there's concerns, if we do see some rain come in, which we know at some point it will, ultimately I think we do see this market turn around. It's just a matter of how high it goes, and that's what we have to be very careful about in this type of move.
Those concerns specifically are in Argentina. Why has Argentina had so much influence?
Boy, they sure have this year. It started off with some talk about La Nina and the impact it could have on Argentina, and that's following through. The big thing is because of the amount of meal that they do produce and their importance. If you look at it, soybean oil-wise, they're about 49% of the world exports on soybean oil, soybean meal about 47%. Of their soybeans, they end up turning about 78% of those into soybean oil and meal. And so if you look at that, how does that compare to the U.S.? Well, we only turn about 44%. So it's all really about the meal and the markets that they're going to go ahead and service.
So are you telling me the meal and oil are so important that Argentina, the third largest exporter of the oil seed, can have that much impact?
Yeah, that's what we're saying so far. But I think the story goes a little further than that, Jeff. And a little bit of that is the fact it's been kind of a perfect setup. We had the funds short on both on the bean side, and they were that way on the corn side. They're still short on corn, but they actually, as of this morning, we have them long about 17,000 contracts of soybeans. They've also quietly been building a long position over on the meal side. So they're betting right now that these markets are going to go higher. But I think this is the type of market that we really kind of got to be careful with from the markets. It's a little bit fragile.
If the meal is rallying so much, why wouldn't the end user, the buyer, just take the oil seed and crush on site? Is that a possibility for some of these buyers?
Yeah, it definitely is a possibility. We know that if you take a look at the big buyer in the room always, isn't it? It's China. We know they've got crush capacity to do that, but it comes down to dollar and cents. If they can pick up the meal somewhere else, they'll go ahead and do that. If they need to crush some more beans, they could. The other thing is that we have to look at the amount of crush capacity out there. We can probably add about another 5% to the crush, which means we could send out about another 2 million metric tons of meal. Our estimations out of Brazil would say that they probably have about 20% of their capacity yet. that they could send out on the meal side, which is an amount to rounding off around 6 million metric tons. So there's still some excess capacity out there yet. The question is at what price will it get pulled in and who will send it out?
Anticipate those margins are getting very nice.
You know what, the margins are very good, and we've seen that here locally. What's happened is that we've seen a run up in the beans, but yet at the soybean processing plants, the margin, basically the basis is not moved. So we've seen a very nice increase in crush margins, and what the processors are telling us is that send us all the beans that you can send us. We're still willing to buy them at that same basis we were at before.
Do you think Brazil has helped temper this market at all? Because the USDA believes conditions have been very good there and yields could be very good as well. So have they helped drag the market down at all?
Yeah, I think they have. I think they've slowed the move up a little bit. I think without such good conditions up there, I think the one part about that, let's look at it, out of the last report, Argentine production came down 2 million metric tons. What'd they do? They raised Brazil a couple more. And so overall, we're fine on soybeans. And the one concern coming out of, I think, Brazil is that it is a little bit wet. So that is slowing up harvest. But I think as we get going, they could put some pressure on this market yet, because I think we could see a little bit bigger yield out of Brazil yet.
So I'm going to slide into some selling options for soybeans here, and then we'll move on to corn. But how do you work this out? Because it feels like this thing could collapse if there's rain in Argentina or if Brazil yields start coming in very well. But on the flip side, if it doesn't rain, it feels like there's move to the upside. So tell me what this means.
Yeah, so what I think it is, Jeff, and we were just talking about this in the office this morning, and I think this is a move that we're in amongst. What we know is it'll end at some point quicker than we're ready for. So what we have to do, I think, is we have to get some sales on. We're setting about 50% sold of our insured bushels, give or take a few percent. We're looking to go ahead on any additional strength to get additional sales made. What I think you could do, just in case the top would head off and go higher, I think this would be a perfect place. Make your cash sales, come up and re-own with some cheaper options on the call side, and that way you've got a floor in place. Because if conditions do change and this thing comes back, there's a lot of room for it to come back.
There has been a plodding rally in corn. Does anything look attractive?
Yeah, I think so. I think what we're looking for is that we'd like to go ahead and see our first round of corn sales really up around that $4 area. If we were to look back to last year and say, what do we think is possible? Well, last year we actually got up to about 418. Is it possible we get a chance to sell another round of sales up in that area? It sure is. We'd like to get a couple rounds of sales on before the planting intentions report at the end of the March, because we're not sure what that's going to show. Is it possible that all of a sudden maybe the acres aren't a lot different? So we're looking to reward the rally in here, even though it hasn't been great. On the old crop side, we wouldn't mind also making some sales here on some of this old crop at this time.
Next week, John Moret from J.E. Moret Grain Company will join us to look at corn and soybean markets. Recently passed federal tax laws may have made grain marketing more intricate for U.S. producers. The complexity stems from a change to the Section 199 deduction. That deduction, according to Greg McKee, a Nebraska Extension rural cooperative specialist, applied to pass-through entities, such as co-ops. Those entities were allowed to take a deduction on their profits, then pass through the remaining balance to their members, which included farmers. But the new legislation, Section 199A, allows both sides to take a deduction, with the farmer deducting the gross sale of grain rather than the net. That amount could be large enough to incentivize growers to sell to a co-op rather than a private company. Greg joined us Tuesday afternoon to further describe the Section 199A deduction.
This is a pair of new deductions that the Congress has passed. One of the deductions applies specifically to a farmer. The other applies to cooperatives. The farmer's deduction is 20% off of payments that they might receive from a cooperative, through a sale that they might make to the cooperative on their grain. And then the other deduction is 20% for the cooperative after making those allocations to the membership on their profits as well.
I'll ask a two-part question here. What changed with the recent tax bill, and how does this differ from what was previously in place?
So the change in the tax bill now is that there's an element of a deduction both at the cooperative level and at the farmer level. That second piece of it didn't exist previously. And then, of course, the magnitudes of the deductions have changed. In the former deduction, it was up to 9% of the cooperative's profits. Now it's up to 20%, with different limitations and different conditions.
So give me an example of how this would work.
Right. So if you were a farmer, let's take a very simple reading of this new tax law. We don't know a lot about how it's actually going to be applied. But suppose a farmer was making a sale of their grain for $120,000. Okay, that was the profit that resulted. So it's maybe a $300,000 sale to the non-grain co-op or a non-cooperative company, and then it has expenses of $180,000. So that's your $120,000. So it looks to me like the law as it stands could allow the farmer to have a 20% deduction on their profits. Now that means profits on the $120,000 or $24,000, so that leaves them with $96,000 of taxable income. But if they sold to a cooperative, the math gets a little bit different. You get the deduction this time on a payment that you would receive from a cooperative. Remember, that's a $300,000 sale of grain. You get a 20% deduction on that $300,000, $60,000 that didn't exist before. Now, given the limitations of how the tax law is going to work, let's suppose that farmer takes the standard deduction on the profits that they're making on their farm. Let's say that's $12,000. Well, that's now 60 plus $12,000 or $72,000 off of their $120,000. Certainly that's a much smaller number that becomes their taxable income when marketing through a cooperative as opposed to the non-cooperative. So the incentives are strong for the farmer.
So what should the farmer do then?
You know, I'm going to have to wave my hands here, and that's because after the strength of these incentives became clear to both cooperatives and non-cooperatives, there's been an effort since then to actually change the language. Now, that process has not finished, so there's questions about what will the new policies be, what will the new language of the rules be that the IRS will administer. So, unfortunately, I have to say things like, whatever the farm's current tax strategy is, you'll have to follow that. I suppose a farmer could then pursue making contracts based on what the tax law is today, because it is this 199A that is the law today, and then act in accordance with some kind of retroactive component to it later on.
To be clear, this would not necessarily be applicable for all farmers, correct?
That's true. This 199A deduction is only available to entities that are not C corporations or incorporated as C corporations. So what happens to them is that they're able to take advantage of that 21% tax rate that's now present in all C corps. But if you were a farm that had a relatively lower tax rate prior to this tax change, you could be looking at a tax increase.
And if you had little to no taxable income?
It's also the case that you simply can't take advantage of a tax deduction. That is one of the limitations. So in that sense, the 199A wouldn't have any effect on you at all.
You hinted at this, but what do you think the outlook is for changing this to the way it was previously?
Right, so it's not clear to me that there will be a new policy that will look exactly like the old 199A. I take that because in the initial introduction of the legislation, 199 was gone. And yet in the negotiations that are happening, it's clear from both sides of the discussion that they want to return to some kind of parity between co-ops and non-co-ops. In fact, the original request for the 199A was in recognition of C Corps receiving this relatively large 40% really tax deduction at the top level, to giving something similar to the kinds of corporations that are pass-throughs. That is where the income is passed directly back to the owners who don't get taxed at that corporate point. And so the 199 deduction that used to be there was something that these cooperatives looked at as, we would like to have something back. So whatever the deduction will look like in the end, it will be some kind of attempt to preserve maybe some kind of parity in the competitive situation, but also to get back to some kind of tax deduction that allows cooperatives to deduct some of their income on their profits, which then often they pass through back to the farmers anyway, and also maintain, like I said, the competitive framework.
You can find more information on Section 199A by reading Greg's recent Cornhusker Economics article, available through a link on the Market Journal website. Greg also advises producers to talk with their tax professional about their specific situations in relation to the deduction. As American farmers and ranchers continue to expand, the USDA expects 2018 will be a huge year for meat output. Producers may generate record amounts of beef, pork, and poultry this year. That could increase competition and pressure prices. Purdue ag economist David Widmar joined us earlier this week to describe the forecast for U.S. consumption of each meat. We started our conversation by asking what we could expect for total meat consumption in 2018.
Total meat consumption in 2018 is supposed to be up. This is our fourth year higher. We're expected to come in at 223 pounds. That's significant because this is the highest level we've recorded total meat. This is red meat and total poultry combined. This is the highest levels we've seen going back to the 1970s, and we finally exceeded our pre-recession levels of 222 pounds back in 2007 and 2008.
Describe what happened during the Great Recession and the recovery we've seen since then.
Yeah, so we sort of had a couple of factors come together. Started off with the Great Recession. Of course, the economy slowed down, the housing bubble. Consumers pulled back on meat consumption. And then, of course, we had some adjustments in the ag sector as well. We had strong commodity prices and a pullback in production, which sort of prolonged the reduction in consumption. And so we've had about 6 years of decline. Starting in 2015, we saw an increase. So about a decade here to recover. 6 years down, 4 years up. But we've seen some pretty strong recovery here in the last few years. And that's really some of the strongest recovery we've seen going back to the mid-1970s.
Well, and that recovery is especially important to beef, correct?
Yeah, probably one of the strongest recoveries we've seen in beef. In total, we've seen beef consumption climb up from 54 pounds during the trough here a few years ago. We've seen 3 solid years of increases, and now we're at 59 pounds, which is very impressive. We've had a 5-pound increase over the last 3 years. Several years with 2% and 3% annual growth in consumption. 2018 expected to be at 4%. Really, this beef recovery is not impressive because of the magnitude of the recovery, more than just the fact that there is a recovery. We really haven't seen beef consumption tick higher. Again, going back to the 1970s, we've seen a pretty steady decline in consumption, and so the fact that we've seen a recovery here is noteworthy.
Well, pork is kind of unique. Well, I should say kind of different among the 3 meats in that it doesn't really change. Why is that?
Yeah, we sort of have a trend for each of the meat categories, and the trend for pork is sideways. Really going back to the 1970s, pork consumption has hovered around 50 pounds per person per year. During the recession, we pulled back a little bit, but we've since seen a recovery to more than 50 pounds. Again, a lot plays into consumers and consumers' choices when they're deciding to purchase the meat and then how they substitute.
And meanwhile, chicken just keeps climbing. What do we expect to see in 2018?
2018, a record year for poultry consumption at 112 pounds. It's interesting that poultry consumption was about 50 pounds back in the 1970s. In the early 2000s, 2003 to be specific, we crossed that 100-pound threshold. We increased a little bit from there, but then pulled back to 100 during the recession. Now we're back to 112 pounds, back above those pre-recession levels. Strong poultry consumption here in the U.S., and that's been a story that's been going on for a long time.
Finally, you track red meat consumption as a total meat consumption, as a percentage of. What does it show this year?
Yeah, so we're creeping back above that 50% mark. Beef or red meat as a share of all meat consumption is back above 50% of consumption. Going back to the 1970s, red meat's share was almost 75%. So thinking about 4 meals, 3 of them being beef in the 1970s, or red meat in the 1970s, and now we're down to about half of them being red meat and half of them being poultry. So a big shift in consumers' preferences over a generation or two.
As we've mentioned, David writes for the website ageconomist.com along with Purdue economist Brent Gloy. David's article on 2018 meat consumption levels will appear there soon. In previous episodes of Market Journal, you've seen interviews from the Nebraska Crop Management Conference held in Kearney earlier this year. At the event, Nebraska Extension agronomist Roger Elmore explained why corn farmers should think about growth and development of plants as 2 separate terms. He also said it was important producers understand what normal is during the season. We started our conversation by asking what normal means.
Well, normal, first of all, is a setting on a clothes dryer, right? So if you don't know normal, though, in terms of corn, and our whole system on corn development and growth was based on what does a perfect plant look like. And I'm convinced that you need to know that so that when something abnormal shows up, it's glaring, it's right in your face. You know that this is not a normal development or growth.
Is it easy to describe what that normal plant looks like?
Well, yeah, the cover corn pictures, that you see in the magazines. That's the perfect corn. and you know, no blemishes. It's been photoshopped or whatever, but that's the perfect corn. It's hard to find, but we've got images of that, and it's kind of like knowing the difference between what's the word for a counterfeit money.
Oh yes, I don't know the term, Roger. You must know it better than I.
Yeah, I lived in Argentina for a year, and so I know that I saw a guy counting a whole stack of US $100 bills one time, and he was going like this, and in my poor Spanish I said, so are you counting them? And he said, no, I'm feeling them. Feeling them for counterfeits.
Yes.
So that really drove the concept of that I just presented, that you need to know what the real thing is like, what it looks like, what it feels like, what it acts like, in order to know what the abnormal is.
So how important is it to know how corn normally develops then, the developmental stages of corn?
Well, there's a certain sequence of development. You know, it goes from vegetative to reproductive stages. In terms of growth, it goes from short, you know, embryos to plants in a systematic way. So that's part of the feeling of it, is knowing if something is out of sequence, if it happens too fast. You know, you can have V6 corn that's this tall versus V6 corn that's this tall. So you have to know how to count the leaves and say, well, what happened here? Why is this one so short? What kind of, and that's the difference between growth and development. Development's the leaf number and putting on new leaf numbers in a sequence, and growth is literally an increase in height or dry matter or something. So why is growth so poor in this one field? And so what was the stressors that came in at that moment? Those are the questions you have to ask.
So it's critical to think about growth and development as two totally separate terms.
Yes.
Okay. Well, how do you use this then? How do you use all this information and try to make management decisions?
Well, there are certain things you can correct and certain things you can't. You know, early season, there are a lot of issues that come up with emergence and very variable emergence and developmental stages in the same row, and there's a critical time there when that needs to be assessed. If you have a lot of variation, you still may have time to replant. So that's the easiest thing to think about there, is that early season hail, frost, there's times to do something else, replant corn or replant another crop. As you get later in the season, obviously if it's a disease situation that comes in or something, you really can't do too much about that. You know, perhaps fungicides if you're early enough in the season, but basically you're locked into that crop for that year, so what you use with that information pertains to next year more than the current year.
Next week, Nebraska Extension's Brian Krinke will join us to discuss sensor-based nitrogen fertigation in corn. The February Nebraska Farmer explains why multi-hybrid planting can be hard to master. In this month's issue, you can read about Central Valley Ag's first year of multi-hybrid planting research, including a few key takeaways about pairing the right hybrids for the appropriate location. The challenges include finding varieties that mature around the same time in the fall and eliminating disparity throughout the growing season. You can read more about the opportunities and hurdles of multi-hybrid planting in the February Nebraska Farmer. And now with this week's weather forecast, here's Nebraska Extension ag climatologist Al Dutcher.
Well, folks, here again for the weekly forecast. During this last week, nothing in the way of any significant moisture across the state, although we did see a warming trend during the middle part of the week that removed a lot of our snowfall that occurred the previous week, especially across eastern Nebraska. Not a lot of moisture with that snow, so it went away quickly. Further to the south, we do have some significant problems as they've been missing out on many of these precipitation events, and if we go to the latest drought monitor, draw your attention to this wide, expansive area of D3 conditions, which is extreme drought that has been expanding. Most of these areas now pushing 4 months without measurable precipitation. We are starting to see significant recovery to the southeast as many of these waves have been relaying heavy precipitation in this area. We do need to see this area improve, or we're going to really have to pay attention to this as we get into the heart of the growing season. As we look at today's model updates, we see the upper air trough that was responsible for bringing that cool trend at the end of the week. It's now starting to shift to our east. That's going to allow our temperatures to start warming as the surface high pressure system continues to move to an east-southeast direction. Backside will start to pump up some of the warmer temperatures from the southern plains. We do have a frontal boundary that will lay out precipitation, a very narrow band of it from Texas to the eastern seaboard. But then as we go into tomorrow, we start to see a trough deepening in the western United States. Surface low in southeastern Colorado will really pump up the warmth into our region. We're looking at 60-degree temperatures right along the Kansas-Nebraska border, 50s across the state with the snowfall well to our north across the northern plains. On Monday, this trough deepens, starts to push toward the east. Cold air filters in across northwest Nebraska, and that will push across the state during the day with surface low basically indicated in the southeastern Colorado region. Layer of snow from northern Colorado up through the northern plains looks to be the forecast. That might slip a little farther southward and give more of that to eastern Nebraska, but surface high pressure on Tuesday builds into our region with that cooler trend and will remain cooler than normal for the remainder of the week as most of the heavy precipitation moves off into the eastern Corn Belt. On Wednesday, we see that trough to the southwest, but we also see a little bit of a trough in the northern stream. We're kind of caught between these two flows. So surface lows across the southern plains will likely lead to some precipitation to our south and southeast, particularly from eastern Texas northward into the eastern Corn Belt. And then as we go into Thursday, we see a little bit of trough in action trying to push across the northern plains. Surface lows still remain in place across the southwestern United States. The combination of the lows to our south and high to our north will mean there will be an area of precipitation breaking out primarily over the central Rocky Mountains. And then as we go into the day on Friday, we see a little bit weak disturbance in the northern stream moving across the central plains. Surface lows just to our south. Well, and that combination will allow some precipitation to break out, particularly across eastern and northeastern Nebraska and points up into the Great Lakes region with heavy moisture across Illinois and points to the east. In terms of the 8 to 14 day forecast for next Thursday, the following Tuesday, warmth continues in the forecast with cold to our northwest. In terms of precipitation, a widespread band of above normal moisture from the southern plains all the way into the eastern Corn Belt.
Thanks, Al. Today's interviews are available individually on the Market Journal website and through the Market Journal mobile app. They include information on corn and soybean prices, the Section 199A deduction, meat consumption, and corn development. As always, you can keep up with Market Journal during the week by following us on Twitter, Instagram, and Facebook. Next week, John Moret will be our market analyst, and Brian Krinke will discuss sensor-based nitrogen fertigation. Until then, thanks for watching. I'm Jeff Wilkerson. We'll see you next week.
Join Market Journal online at marketjournal.unl.edu. You can also follow us on Twitter, Instagram, and Facebook. Promotional support is provided by the Nebraska Farmer Magazine, and major funding for Market Journal is provided by the Nebraska Corn Board. Market Journal is produced by the University of Nebraska Lincoln's Institute of Agriculture and Natural Resources.